It's almost 11 a.m. in Hong Kong and 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Fed officials see just one interest rate cut this year and forecast more for 2025, reinforcing bets on higher for longer rates to suppress inflation.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
We've got Asian stocks swinging around as the Fed's cautious outlook on rates does little to deter bets on cuts. The S&P 500 topping 5,400 for the first time. Plus, India's inflation eases only slightly in May, staying above the RBI's target and justifying its caution on rates. The recent heat wave sparking fears of a food price hike. All right, let's check in on how markets are faring after that Fed decision. Avril Hong's in Singapore. Avril.
Yeah, Paul, I mean, this time yesterday, we were really waiting out for the U.S. data and the Fed dots. Now we've gotten both. But it's interesting to see how in the Asia-Pacific markets, there doesn't seem to be that one clear narrative that markets are running on. I mean, we did see cooling inflation, the core CPI rising at the slowest pace in more than 3 years. So raising hopes that we're going to see that soft landing. As for the Fed, the change in the outlook for interest rates coming in a bit more hawkish. But it seems that the S&P 500 running above 5,400, the mega caps getting lifted overnight, the initial exuberance in Asia markets didn't quite translate into what we're seeing. So Hang Seng, Kospi, they are pairing gains from earlier on in the session. We're seeing the dollar pick up. The Korean won is benefiting from the lower U.S. yields. But look at the way that the yuan as well as the Japanese currency are faring. Of course, we're keeping a close watch on what we're going to get from the BOJ tomorrow. But let's also digest and unpack what we got from the Fed messaging overnight. Take a listen.
We see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant, beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having, the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
Powell, they're essentially pushing back the timeline of rate cuts on the Fed dots. We're just getting one this year. We saw that kind of affecting treasuries and the dollar overnight. But for stocks, does it actually matter? If you take a look at the results of the MLife Pulse survey that came out just after the Fed decision, about 100 respondents, more than half of them think that regardless of whether we get cuts from the Fed, the rally in the broad-based gauge is likely to continue this year. It's the idea that the AI theme is going to drive things along. About a quarter of the respondents think that the Fed cuts will be necessary for that rally to continue, and the rest of them think that, it would fade if we don't get that rate cut. That's interesting to keep an eye on, Paul.
All right, thanks very much, Avril. Let's get more on markets now with Sunil Cole, APAC equity strategist at Goldman Sachs. And Sunil, I just want to start off with that MLive Pulse survey. I'm wondering if you were perhaps among that 54.6% who feel that the Fed's not quite as important a catalyst these days as it used to be. Are you sort of looking at markets now and thinking more in terms of fundamentals, earnings, outlooks, dividends, the AI theme, that kind of thing?
Look, Paul, the fundamentals obviously do matter. We do think that the Asian markets in general should be higher over the course of the year, sort of call it 10% upside for MSCI Asia Pacific ex Japan index, which is largely a function of the underlying earnings, because we think valuations in aggregate are kind of fair. So I think the more upside on Asian equities on the back of fundamentals is our view. I think having said that, I do think Fed is important. I mean, the fact that we got softer than expected CPI, 16 basis points on core month on month, which is at a 33-month low, is encouraging. Our house view, however, is that we will continue to see better inflation news in coming months, which therefore still makes it reasonable for Fed to cut in September. So we're still keeping 2 rate cuts as a base case for us. But obviously, these cuts we think are still sort of optional, given kind of growth is still holding up. But we think inflation will continue to trend down, which will give room for Fed to cut rates, and so that would be important to the markets as well.
All right, let me put a potential risk on the table for you, and that is the US election coming up in November. Regardless of who wins, can you foresee more spending, greater or looser fiscal policy, greater deficits, more debt being issued? Is that perhaps a risk to the inflation story in the US?
Look, I mean, there is always kind of these nuances. I mean, as I said, we do think over the course of sort of year, we think markets would be higher, 10% upside. But to your point, we do think the path to that would be kind of much more subdued in the next sort of 3 to 6 months, and then you get more towards the year end, and you could see more stronger gains and rally, which is kind of the typical seasonal patterns. And one of the reasons for expecting more kind of subdued returns in the near term is due to the expected more volatility in the markets, partly because of the US elections as well. So our team did run some scenario analysis in terms of various potential US election outcomes. And so I think the markets will react depending on whether you see a Republican versus Democratic, or whether it's a divided House versus not divided. But what's fair to say that there will be higher volatility in the markets heading into the elections. Dollar may well be stronger, which obviously has implications for portfolio flows and sort of feed across to other currencies in the region as well. And I think specifically if we get a divided house, that itself generally tends to be not great for asset classes in general. So we do expect more volatility in coming months on the back of elections. But I think once that's past us, we probably could see fundamentals again driving markets higher.
Well, in terms of central bank watching, of course, our focus is now switching to Japan, the BOJ meeting coming up tomorrow. We are expecting a reduction in bond buying. That's been foreshadowed. But what are you expecting to hear in terms of potential tightening from the BOJ? How many basis points might we see, and when might we see it?
I mean, look, we do think that there might be sort of some reduction in purchases there from the BOJ. But I think having said that, I think the key risk for the markets here is that you still got kind of wide rate differentials between kind of US and Japan, which means that you still have a modest kind of weakening bias in the currency there. And so if we continue to see that happen, I think that would have some read across to the other currencies in the region. Notably, obviously, Korean won is one of the key kind of funding currencies as well. So we're sort of particularly watching the BOJ and the moves in yen in terms of what it means for the rest of the regional currencies, and if there is any sort of potential weakness we could see on the back of that. So that's, I think, something we would watch for long.
Yeah, we've got the yen hovering just around 157 as you're speaking there. Do you expect any rhetoric to try and put a floor under that from the BOJ?
I mean, look, the central bank has been trying to support the currency as well, but I think again it could do that. But our sort of fear more tactically is that it's difficult to see the sustained appreciation in yen given the rate differentials in there. And so if the fundamentals do reassert themselves, you could see that weakening bias in the currency again. So I think that's what we're kind of watching out for.
So we've got a PBOC meeting next week as well, and I just want to take a look at this chart on the Bloomberg terminal. I'll describe it for you. It shows 30-year borrowing costs for China and Japan starting to converge. Do you feel we're seeing a Japanification going on in China, and what might the PBOC do to avoid that?
Look, I mean, there has been a lot of talk in terms of client conversations around that sort of topic in terms of Japanification of China. What I would say is that in general, our views on China are centered around the fact that, look, you had a big pop in the markets, 30% rally from the bottom. The market has come off around 6-7% from the top, partly because of profit taking, partly because I think the sense among investors is that you did not see as much forceful easing, especially on the property side. And I think that the key for markets here and the economy is that if we continue to see more policy easing, especially heading into the plenum, which is the July 3rd, which is I think what everybody's kind of watching for, I think you need more sort of policy easing for markets to do better and economy to do better in China. And then I think the other thing which we are very focused on is what happens on the corporate earnings side, because so far we haven't seen any major pickup in earnings in China. And so we are still kind of hoping to get around 10% earnings growth this year and next. And if the numbers do come through, you could see market having another leg up higher in China.
All right, Sunil, I think we've covered the macro backdrop pretty well here, but do stick around. I want to get your views on equities investing strategy next. Sunil Kaul of Goldman Sachs is staying with us. Up ahead, though, on Bloomberg Markets Asia, Elara Capital says Prime Minister Modi's cabinet selection bodes well for India's markets. We'll find out why later this hour. This is Bloomberg. All right, let's take a look at how China's EV stocks are faring. Bit of a mixed bag here. This is after the EU decided to impose tariffs on imported Chinese electric vehicles. Forget that, look at BYD, it's up 7%. Now, why? Well, we've got some Bloomberg intelligence analysis on this. Says BYD's best able to absorb most of the burden from EU import duties. Its cars carry peer-beating profitability. They're subject to a 17.4 added tariff versus a 21% industry average. SAIC, meanwhile, that's suffering the most. This is according to Bloomberg intelligence as well. MG might need to lift retail prices, but that might hurt demand. So SAIC there suffering a little bit, but the other automakers in that context not doing too badly. All right, Beijing, however, understandably, blasting the EU's move to slap those extra tariffs on Chinese EVs. The Commerce Ministry says the EU is ignoring the facts and WTO rules. China correspondent Min Lo is in Hong Kong and following the story. So Min, Beijing hitting back at these tariffs. How will they retaliate?
Yeah, Beijing has responded strongly, saying that these tariffs lack a legal and factual basis, and they said that Europe is weaponizing these trade issues. Have a listen to what the Foreign Ministry had said.
The anti-subsidy investigation is typical protectionism. The EU levying additional tariffs on EVs imported from China violates market economy principles and international trade rules, disrupts China-EU economic and trade cooperation, global automobile supply chains, and will eventually undermine its own interests.
Well, China has hinted previously that they could impose a 25% tariffs on vehicles with large engines that are coming into China, and that will hurt companies like BMW and Volkswagen as well. Many of these German car makers, especially, they're selling millions of cars into China annually, and so the German Chancellor has been one of the most outspoken in criticizing these EU tariffs. Beijing has also hinted that they could impose tit-for-tat levies on other European goods like agricultural products, dairy products. They already have opened up a probe into European brandy. Aviation products could be in the crosshairs as well, so that could affect Airbus. We know Airbus has been negotiating a huge deal with Chinese airliners, so that could be, affected as well. So a lot to look out for in the coming months as to how Beijing will respond.
Min, we were taking a look at some of those Chinese automakers just before this conversation, and some are doing reasonably well. Can you give us a bit more of an explanation of how these tariffs are affecting the different automakers in China?
Yeah, we're looking at different tariff rates for different companies here. And of course, BYD stands to gain the most market share because they're looking at a less than industry average tariffs of 27% in total if we add in the pre-existing tariffs of 10%. SAIC is going to hurt the most because they have 48% tariffs, and they also have the largest market share in Europe. Europe represents 10% of their global sales, as opposed opposed to just 1% for BYD. And of course, BYD also has the most cost advantage compared to its rivals because it is the most vertically integrated. Of course, it had started with making batteries first before they ventured into making electric vehicles. And these tariffs, they also only target battery electric vehicles, but not the hybrids. And so this bodes well for brands like BYD as well as Volvo that has a presence in those areas. But there's no doubt that the tariffs, they are going to hurt these Chinese EV makers because they are largely, they're facing a very intense and brutal price war in China right now. They really need the overseas market where they can sell the cars at a higher price to get a bigger profit margin. But these tariffs are certainly going to cut into their profits. They may have to hike prices by 15, 20, even 30% to pass on some of these additional burden onto consumers. And that's going to make their cars less attractive, and it could slow down their market penetration rate in Europe as well.
All right, Bloomberg's China correspondent Min Lo there. Let's get back now to Sunil Kaul, APAC equity strategist at Goldman Sachs, staying with us there. Sunil, thanks for your patience. I just want to talk a little bit about some of those China EV names. Even these tariffs notwithstanding, we're seeing some of those names like BYD doing quite well. Would you be a buyer of Chinese EV stocks?
Look, within the broader China market, we do like a couple of pockets. Part of them is kind of the broader sort of internet, because we're kind of seeing obviously strong numbers there, but also kind of earnings upgrades. That I think one positive part in the Chinese equity market. We're also kind of quite positive on the broader theme of cash holder returns and the fact that in many companies, payout ratios are still lower and cash is high and they can kind of increase that. I think those are the pockets we're kind of much more focused on. I think with the related to EVs, obviously there are some names we like fundamentally, but from a broader sectoral perspective, I would say we do like some of the consumption names, some of the other pockets I mentioned, but sectors where there is supposedly going to be more kind of regulatory risks going forward, we are generally sort of more cautious around that. And I think that goes, Paul, back to the earlier conversation we are having, is that heading into the US elections, and depending on what the outcome could be, geopolitics and sort of tariffs and other sort of news flow could again come as a center of people's mind, and then you could see some volatility around many of these names. So if we look at objectively what the market has been pricing in, and we have a few proprietary indicators which look at the level of risk that's been priced in around many of these names that are sensitive to some of these geopolitical shocks, the market is going to pricing in a much moderate risk, which means that if there is more sort of news flow or adverse news flow, you could see more sort of negative share price reaction in many of these stocks. So the market is not fully pricing the geopolitical risk, and there could be sort of much more risk, especially heading into the US elections in the coming months, I would say.
How about in terms of domestic policy within China? Because I know you say that you do see a scenario where the Chinese rally can run further, but what we seem to be having happen is we'll see a policy announcement, stocks will rally and then pull back as reality sinks in. Do you think the pressure's on the PBOC to some degree to deliver some more concrete funding support?
For sure. Look, I think they would. Our sense is that they would get to the around 5% sort of target this year, given the strong Q1 print. But to your point, I think for sure they would need more forceful policy response for restoring confidence. I think that could involve kind of more central government sort of borrowing, transferring more to kind of municipal corporations to spend. It could also mean some of the monetization of assets they have. We could see sort of increased kind of support to the property sector. I think the money they have earmarked for it, close to RMB 300 billion, that's not enough. I think our own estimate suggests that at least you need a trillion RMB, if not more. And so we could see sort of more sort of policy measures around many of these dimensions I just mentioned, which I think is critical for confidence to build up, as I said, and in addition to corporate earnings coming through.
All right, I want to get your views on the China versus India story. Which of those markets would you be more heavily allocated towards?
Look, I think we do like India as a structural play. Obviously, we just had elections out there. I guess the main concern from investors in the last week or so has been around the fact that does it kind of impact the growth story in the sense that you got a reduced majority from the incumbent NDA government. Our own sense is, look, I mean, if you look at the ministry allocations we just heard of a couple of days back, it sort of broadly reaffirms the policy continuity. Most of the key ministries have been held by the same ministers which were there in the past 5 years, and so it's a message of policy continuity from India. We also are, I mean, India is also a market where we have seen exceptionally stable macroeconomics, sort of fiscal consolidation in place, inflation under target, RBI having ample reserves. So we think macro stability continues there. And we are also seeing this as a market where earnings continue to come through. Last year, we got 20% earnings growth. The first quarter reporting season we just concluded, we had 16% earnings growth. We think looking forward, this is a market that can give you another sort of 15% earnings growth this year and next, which will drive markets higher. So I think it's a structural market for it. Growth fundamentals still look very strong, whereas I think China is obviously a recovery from cyclical lows where positioning is very light, valuations are still sub 10 times forward earnings. And so we can kind of like both the markets, but I would say for different reasons.
Well, we did just get some continuity out of India as well. The finance minister being reappointed. We'll have a budget in July, of course. Do you see any major changes to the infrastructure reform agenda? Because, of course, there are coalition partners involved in this government now. And does that inform any sector rotation for you?
Look, I think that's a great question, Paul. Again, I think that was the fear of the market, that with the coalition government in place, do they have to trade sort of many ministries with some of the coalition partners? I think as we just saw from the appointments you just mentioned as well, is that I think out of the 30 cabinet ministers that were appointed, 25 of them are from the incumbent BJP, and most of the ministries have been repeated. So we still think that the government's thrust on infrastructure will continue more around sort of railways and roads and a little bit of rural infrastructure as well. Housing would be a key area in terms of the policy there. I think the one thing to your question, what could happen is that incrementally we do think there could be a little bit more sort of support towards sort of rural consumption and rural recovery. And that probably means that from an allocation standpoint, before elections, we were very clear about favoring investment cyclicals and industrials over the consumption pockets. I think after that, we have sort of made some allocation changes. Notably, we have sort of upgraded staples from underweight to market weight. And so we think now it's a time to be kind of much more balanced between kind of investments and consumption there.
All right, Sunil Kaul of Goldman Sachs, thanks so much for joining us with your insights. We'll just take you to Wellington now in New Zealand. We're seeing live pictures there of Chinese Premier Li Qiang. He is now meeting with the New Zealand Prime Minister Christopher Luxon. The formalities outside Government House have concluded. Now they have moved indoors. Li Qiang on the first stop of a three-nation visit, coming to Australia and Malaysia next. More in a moment. This is Bloomberg. Let's take a look at some of your global market movers there. Equities having a reasonably good day after that Fed meeting, even though we're now looking at probably just the one rate cut this year, maybe 4 in 2025. We've got South Korea's Kospi, one of the best performing indexes, better by about 1.25% right now. Taiwan doing pretty well. We'll hear from Taiwan's central bank later, expected to keep interest rates unchanged. We have more to come. This is Bloomberg.
What is clear here is that having been a little bit burned by the enthusiasm at the end of last year and then the reversal on inflation, they're not going to want to reverse so quickly with just one good print. And he stated again and again they'll need more than just one, and I think that's why you had maybe the hesitancy.
There isn't like any sort of contraction or any recession or any indication of that. It is still a strong labor market, so there is really no reason for the Fed to cut rates.
From our perspective, the FOMC meeting gives us more conviction that there will be cuts by the U.S. Federal Reserve at some point in the second half of the year.
I don't think they can really accurately plan around what fiscal policy might be in the next administration because you don't know the makeup of Congress. It's really going to depend on the full composition of the government, and it's just impossible to predict that.
Some of our Bloomberg Television guests earlier on reacting to that latest Fed decision. Bloomberg opinion columnist Mohammed El-Erian, meanwhile, says it's unclear if the Fed reflected the latest inflation print in its rate decision. He told us the disconnect between markets and policymakers is growing.
I was surprised to hear that 4 voted for no cuts, and I was surprised to see the inflation numbers go up. Both for the PCE, both at headline and core. So the one question I would have for Chairman Powell is, do those numbers and the expectations that 4 people had of no rate cuts reflect this morning's inflation data or not?
Somebody today echoed Peter Orszag, a long time ago of LSE. That's a school, Omaha, southwest of Cambridge. And Peter Orszag talked about glide paths. Is our great underestimation that the glide paths to get out of the pandemic with all this monetary policy is a much longer time frame than we think. We're modeling Fed meeting to Fed meeting, the silliness of September and December, where we should be modeling 2027.
We should, Tom, and I've been urging to combine data dependency with more of a forward-looking view of the economy. But that's not where the Fed is, and as a result, that's not where the markets are. The markets are reacting to every single data point. In the last month, just the last month, 10-year yields went up 30 basis points, came back down 40 basis points, went back up 20 basis points, and came back down 40 basis points. And what you realize is that there's no anchor. There's no longer-term anchor to markets, and there's no longer-term anchor to policies. We should be talking about the big secular changes and how that's going to impact the next 12 months. But that's not where the Fed is, and therefore that's not where the markets are.
Right now, I wonder how significant it is to you, Mohammed, that we did see at least one participant materially mark up their long-term neutral rate as people try to understand what this means longer term for what a Fed rate cutting path could look like.
It's about time. I mean, there is a very active discussion of what's happening in the structure of the economy and why it is that the neutral rate is well above 3, nearer to 4. But the Fed is moving very slowly on this, and Fed Chair Powell has refused to engage in discussions, either saying, I don't care about it, or I don't have a view about it. So, yeah, it's about time. They're going to have to really think about this. But again, Lisa, that is a forward-looking parameter, and this is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
That's Bloomberg opinion columnist Mohammed El-Erian speaking with our colleagues Tom Keene and Lisa Abramowicz. Well, post-Fed, the focus now shifts to the Bank of Japan. Markets in Japan are coming back from the lunch break. Avril Hong's watching what's going on. Avril.
Yeah, Paul, we're seeing that caution creeping into Japanese equities. They are underperforming on a day where most of the Asia-Pacific peers are rebounding against the backdrop of what we got from that U.S. inflation print. And if you take a look at the sectors, it is the growth stocks that are tracking the performance in mega caps, but the Japanese banks, they are declining today. It's the anticipation. Remember, the BOJ could talk about the reduction in bond purchases, and anything more than a trim of $500 billion yen would be seen as slightly hawkish. We're also waiting to hear if the Bank of Japan starts priming the markets for a rate hike next month, saying anything concrete about an increase in interest rates. That's what you're seeing in terms of equities. Let's take a look at Japanese bonds, because don't forget, overnight we saw a bit of a relief rally in U.S. Treasuries, and there's a bit of green coming through in Japan, but whether or not that will last, that is the key question. Our MLive strategist Mark Cranfield has pointed out that BOJ might actually need to be more hawkish than what bond markets are pricing in, because it needs to support, in a way, the Japanese currency. And take a look at how it's been faring this week. Flip the board. On dollar yen, it's still hovering at that 157 level. An interesting perspective that has emerged today is that markets initially focused more on the US inflation print, but now are switching gears and talking more about what we're seeing on that one dot from the Fed this year. And you're seeing the Bloomberg dollar index picking up. That's really going to be key to watch as to the trajectory of the Japanese currency against the greenback, Paul.
All right, thanks very much, Averill. And with that BOJ decision coming up on Friday, investors are now honing in on any clues on quantitative tightening that could help support the currency. Here's a look at the broader implications of a cheaper yen.
Japan is back, attracting people from all over the world with unbeatable deals.
The third time I came, the yen is now very good, so I eat now very, very low cost. And I came here with a backpack with 10 kilo, and now I'm going home with a backpack for 20 kilo, because all clothing that I bought because it's very cheap.
The Japanese currency is trading at levels not seen since the 1990s, and tourists are taking notice.
The Ginza district here in Tokyo has for years been a byword for luxury, just as the rest of Japan has been known for its premium experiences and goods. But with the dollars, pesos, and yuan going much further, plus the 10% duty-free discount, luxury is at a bargain.
But it's not all glitz and glam. For Japanese households and smaller businesses, a cheaper yen has meant real pain.
The price of chocolates and oils has gone up so much. We try to keep the quantity of breads with them to a minimum and make simple breads without imported ingredients.
Companies that depend on imports and rely on the domestic market are suffering from higher costs. And even exporters that would typically welcome a weaker yen are growing uncomfortable. The currency's sustained decline is making business planning more difficult.
A big factor is that when M&A is conducted overseas, we're not purchasing with yen but with local currency. When the price is set in dollars or euro, it becomes much more expensive than when the yen is strong. This has had a significant impact on our business.
And for Japanese towns feeling overrun by tourists, the cheap yen is triggering other interventions. Fujikawa Guchiko has erected a giant black screen to block its iconic views of Mount Fuji. Sherry-Ann, Bloomberg, Tokyo.
Well, for more on the yen, let's bring in Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu. So, Stephen, tell us a bit more about your outlook on the currency ahead of the BOJ decision.
Right, so over the last 2 years, it has always been a rate differential story. So we have to look at the Fed, we have to look at the BOJ. Now, obviously, they are sort of diversing. Now, the Fed, even though it's only like one cut that they are talking about, it's still very likely that they're going to start cutting. So we're talking about lower US rates, probably just a little bit weaker dollar. Whereas for the BOJ, they are going to hike further for sure. And for tomorrow, even though if they're not going to hike, it's very likely they're going to announce a plan for QT or tapering of QE. So right now, they are buying 6 trillion yen a month. In fact, they have bought less than that over the last 5 months. So they will probably announce something around 5 trillion or even less than that. So we're expecting that to help the yen a little bit. Now, in fact, if you look at the rate differential levels, whether it's the 2-year yield gap or the 10-year yield gap, it's calling for a lower dollar yen. For example, the 2-year gap is calling for dollar yen at closer to 150, the 10-year closer to 140. So that's why, even though if we don't get a really hawkish BOJ, say for the second half of the year, we think the rate gap will still move in favor of the yen. So we're talking about lower dollar yen, but just only marginally lower from here.
So what about interventions? Can we see anything more potentially coming down the pipeline?
I think after the interventions since the April 29 near 160 level, right now we are safe. Just because when we talk about interventions, there are 2 metrics. The first one, we talk about level. So clearly 160 is a red line, but we are sort of away from there. And the second metric is actually the pace of yen decline. In fact, over the last 1 or 2 weeks, we are seeing dollar yen basically stuck in the 155, 157 range. So from a pace perspective, we don't see any hurting behavior in yen selling. So that's why I think for now we are safe from the BOJ intervention.
How about impact on other Asian FX, though? How about that?
Right. Obviously, the yen matters. So for Asian currencies, it's the yen and the CNY that always matter. So if we see a yen reaction tomorrow, or say in the July meeting after the BOJ hikes again, then a stronger yen will definitely transmit into other Asian currencies. So they will benefit from a stronger yen. But as we said, after all, U.S. yields are still much higher than the yen. So the Japanese rates. So the dollar yen drop will be sort of moderate, and hence the positive impact for other Asian currencies will be temporary as well.
How about the path of tightening in Japan, though? What are we expecting in terms of that, and is that going to move the needle at all?
I think in terms of QT, like market was broadly expecting about it, but when it comes to FX, it's really about the policy rate. So it depends on how fast the Bank of Japan will hike rates. So I'm just going to quote our economists' forecast. Basically, they're expecting 40 basis point hike in the second half of the year to bring the policy rate up to 0.5%. Now, that's still relatively low compared to the Fed, because the Fed is still 5.5. So even with one cut, we're still 5.25. So that gap is still huge enough so that it's very hard from a rate differential perspective to sort of change the dollar yen upward trend for now, unless the BOJ really delivers some hawkish surprises over the next 6 months.
All right, Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu there. Okay, still to come. El-Erian Capital is going to join us. Well, no, they're not. Well, they are, actually. They're going to share their outlook on India's economy. After that narrow victory that we saw from Prime Minister Modi, he's got coalition partners now. There's a budget coming up. We'll talk about all of that next. This is Bloomberg. Welcome back to Bloomberg Markets Asia. We are watching the India focus, and of course, we're just a couple of minutes away now from the open in India. Looks like it's going to be a modestly risk-on day there as well. That's been pretty much the theme across most of the Asia Pacific today after the Fed meeting. We're now anticipating probably just the one rate cut this year from the Fed, maybe 4 in 2025. We'll hear from a lot of Fed speakers this week, but certainly a bit of a tailwind for Indian markets today. All the major indexes look like they're heading for a positive open. Well, we had some important data out of India yesterday as well. The inflation rate, well, that only eased slightly in May. We're down to 4.75%. It is still above the central bank's target, maybe justifying the need for policymakers to remain cautious. Our next guest expects the RBI to cut rates by 25 basis points in the fourth quarter. Let's bring in Garima Kapoor, economist at El-Erian Capital. Garima, thanks so much for joining us. I want to start off by talking about that inflation number. Yes, it's above where the RBI would want it to be, but yes, it's also coming down. You're confident enough to call this a trend and perhaps forecast when it might get to target?
I think by second quarter, it will actually fall further because of the base effect. What is more important is that while headline will hover around this range, the full year number will probably come close to 4.5% or tad below that given the current trends and if the monsoon is normal. But interestingly, the core inflation that actually captures the demand side impulses has been at an all-time low of 3.1%. So there has been certain expectation by some segments of the market that RBI would probably start cutting rates earlier than anticipated, taking cues from the core inflation. But what we're seeing in terms of recent trends is what I think is likely to be a trend. What we need to watch out for in the near term, of course, is going to be the performance of monsoon.
Yeah, I want to talk about that next. It seems interesting that so much rides on, quite literally, the weather. To what degree is the monsoon the best hope to address very sticky food inflation? And not that the food's sticky, it's the inflation that's sticky. But we've got a next RBI meeting in August. Is that period of time where we get to see how the monsoon pans out, is that going to give them a little bit of breathing room when they consider their next move?
Actually, the forecasts that have been made by various weather organizations, including the IMD in India, has actually projected for a very normal monsoon, in fact, above normal monsoon at 106% of long-term average. But remember, out of 23 years that I was looking at recent data, 11 after 23 years, when our IMD has projected for a normal or above normal monsoon, the performance has come out to be below than what it was projected. So one needs to really watch out for the entire season to play out, number one. Number two, it's not so much about the headline monsoon, but it is more about the spatial and intertemporal distribution that is important. So while you can have certain parts of India which are flooded, you can have some other parts of India probably which are in deep drought. So this pattern is actually that will give rises to steep volatility in food prices. And hence I think RBI is unlikely to react until the entire monsoon period ends, and that's going to be not before September.
So aside from inflation, what are some of the other factors to consider? Because we haven't talked about industrial production yet. That ticked up 5% in April. There's a slight improvement there. What are some of the other factors that need to be considered before this pivot to easing becomes a reality?
I think one of the biggest factors that will play on RBI's mind, apart from the fact that they've of course revised the growth target upwards, so they're not worried about growth as such. They're worried about durability of inflation, particularly food inflation coming down. The other factor, of course, which they're not being very vocal about, and they did indicate that they have an independence with regards to how they will act vis-a-vis Fed. We do think the room for RBI to cut rates before the Fed starts to cut rate probably is very limited, given it being an emerging market central bank. So I would actually look for cues from global central banks, particularly that of US Fed. And although RBI talks about independence, I think they are unlikely to act before Fed acts.
So against that backdrop, we've got a very weak rupee. It's hovering around record lows. What are we, 83, 53, 25 at the moment. If easing is coming and if the RBI does, as you say, move before the Fed, can you see this moving lower? Where's the floor for the rupee?
See, actually, the outlook for rupee actually is on the positive side for 3-4 factors. One, the continuity of the government, especially with the portfolios that have been assigned, gives you confidence fiscal consolidation won't get compromised, number one. Number two, there is enough elbow room in the budget, especially after RBI's record dividend transfer. Number three, from 28th of this month, there's an inclusion into global bond indices, so we'll begin to see much more stronger flows on the debt markets. And number four, remember, we are basically entering a phase where macroeconomic stability is getting rewarded across EM peers. And if you have to pick up one country for macroeconomic stability, along with massive foreign exchange reserves to cover more than 12 months of import cover, I think India would be the one. In fact, I have a call for a much stronger rupee towards the end of the current calendar year, financial year, I'm sorry. I look at rupee at 80 to 50 to 83 by March next year.
So you talked about some of that continuity in the government. Of course, the finance minister reconfirmed in her role. What's this going to mean for potential pressure on the RBI to continue delivering that high dividend transfer? And perhaps it's meant to be independent, but will it feel any pressure additionally to ease?
Unlikely. I think the trio of finance minister, prime minister, and the RBI governor actually have one thing in common, that they all of three agree that macroeconomic stability is of prime importance more than anything else. And that's what you've seen India deliver despite the COVID-related shock. And that's why I think any likely pressure on RBI to cut preemptively or prematurely before inflation starts to show any signals of durably coming down, especially on the food front, is unlikely. When it comes to dividend, if the rate cut forecast or rate cut outlook of global central banks anyway is getting pushed ahead, the massive forex reserves, especially that RBI holds, are anyway going to yield you better yields given the interest rates globally. So the foreign currency earning of RBI is likely to be better next financial year as well. So the likelihood of relatively better dividend stays next year as well. But are these going to be compelled by policymakers or by political compulsion? I don't think so.
All right, well, we've got a budget coming up next month. Do you think the infrastructure spending is going to continue at the same pace that we've seen? Or now that we've got coalition partners in the government, is there going to be some more pressure to introduce greater social spending?
To To be on a very realistic note, some amount of social spending is warranted given India's K-shaped consumption recovery, and given that they have been under series of very high inflation, particularly on food front, ever since COVID ended. Now, on that front, possibly a greater transfer to the farmers, a cash transfer program which government continues, but a hike on this transfer scheme is possible. But unlikely to think that because government is under coalition, there's going to be any successive or incremental pressure for them to get more populist or socialist at the cost of infrastructure spending. In fact, I think after the bonanza that RBI has given, and the very conservative budgeting that the government has done on the budget side, I think there'll actually be an elbow room to hike capex spending despite some populist struck social measures that will come about. In fact, I'm very confident that notwithstanding the fears of a coalition government, because the key portfolios and the ministries are held by almost all the same ministries that were there in the erstwhile government, I don't see any fears of infrastructure spending being compromised for socialists. And if at all some socialist spending has to come, there is enough elbow room and room in the budget to accommodate that.
All right, Garima Kapoor of Elara Capital, thanks so much for joining us. Let's take a look at how Indian markets are doing. One stock in particular that we're focusing on, Paytm. We've just had the news that it's partnering with Samsung. The Samsung owners are now going to be able to launch flight, bus, movie, events, ticket booking on their Samsung wallet in India. This is according to an exchange filing that was filed this hour, just a few minutes ago. So Galaxy smartphone users are now going to have access to Paytm services that are integrated with that Samsung wallet, and we're seeing Paytm stock, 197 communication stock at least, rising about 2.3% at the moment in India. Plenty more to come. This is Bloomberg. Here are some of the top corporate stories that we're following. Vietnamese car maker VinFast is pushing ahead with its Asia expansion plans. The company says it expects to open its India factory in the first half of next year and to begin construction of an Indonesian plant within the next 2 months. Founder Pham Nhat Vong tells us in an exclusive interview that potential tariffs also won't affect the company's growth plans.
I'm not concerned about that. If the market capacity is big enough, we will open a factory and we will become a localized company in that market. In case that market is not big enough, we will rethink. For instance, in India, where the import tariff for EVs are up to 70%, we have decided to open a factory in India, and we are speeding up our efforts on building the factory there. And next year, we will open our plant in India.
OpenAI CEO Sam Altman has told staff the company is on pace for $3.4 billion of annual revenue. The source says he told an all-hands meeting that the vast majority of that revenue is coming directly from products and services. Altman also said OpenAI was on track to generate about $200 million by offering its AI models through Microsoft Azure. All right, let's take a quick look at markets. Before we leave you, US and European futures are online. It's a bit of a mixed bag here. Following that Fed decision, on hold, maybe one cut this year. That is it for Bloomberg Markets Asia. Horizons, Middle East and Africa up next. This is Bloomberg.